Most people think getting rich in the stock market requires luck, a hot tip, perfect timing, or being smarter than everyone else. But the truth is far quieter and far more powerful. Wealth isn't built by excitement. It's built by patience, discipline, and buying wonderful businesses when others are distracted. Today I'm sharing the top 10 stocks I'm buying for 2026. Not to gamble, not to get lucky, but to build lasting wealth the boring, reliable, unstoppable way. Stay with me. This could change how you see money forever. When people ask how to get rich in the stock market, they usually expect a clever answer. Something fast, something secret, something exciting. But wealth doesn't come from excitement. It comes from consistency. Getting rich isn't about being right once. It's about being reasonable for a very long time. In 2026, the goal is not to predict the future. The goal is to own pieces of it. That's why every stock I buy follows a simple rule. Would I be happy owning this business if the stock market closed for 10 years? If the answer is no, I walk away. Stock first, businesses people can't live without. The first category is simple: companies that provide essentials, things people use regardless of recessions, elections, or headlines. Food, energy, basic services. These businesses don't grow fast. They grow forever. They don't chase trends. They survive them. Stock 2, companies with deep competitive moats. Some businesses are protected not by luck, but by trust. Customers return not because they're forced to, but because they want to. Strong brands, high switching costs, quiet dominance. When a company becomes a habit, profits follow naturally. Stock 3, profitable technology, not hype. Technology isn't the enemy. Speculation is. In 2026, I avoid companies that promise everything and deliver nothing. Instead, I look for technology businesses that already generate cash, already serve millions, and already solve real problems. Innovation is powerful, but profit is proof. Stock 4, financial institutions built on discipline. Banks and financial firms should never be exciting. They should be boring, predictable, carefully managed. The best ones grow slowly, lend wisely, and survive downturns without drama. When money is handled conservatively, shareholders sleep peacefully. Stock 5, consumer businesses with pricing power. Inflation reveals the truth. Some companies struggle when prices rise. Others quietly pass costs along without losing customers. That's pricing power. When customers are willing to pay more without complaining, you're looking at a remarkable business. Stock 6, industrial companies that build the world behind every modern economy, are companies that manufacture, transport, and maintain infrastructure. They're rarely discussed, rarely trendy, but absolutely essential. Civilization doesn't run on excitement. It runs on steel, logistics, and reliability. Stock 7, long-term energy and resource leaders. Energy transitions take decades, not headlines. The smartest investments aren't ideological. They were practical. Companies that responsibly produce, manage, and transition energy will remain valuable no matter which direction the world moves. Stock 8, businesses with simple, understandable models. If I can't explain how a company makes money in one sentence, I don't invest. Complexity hides risk. Simplicity reveals strength. The best businesses don't confuse customers or investors. Stock 9, companies that reward shareholders. Great businesses respect ownership. They reinvest wisely, return cash responsibly, and treat shareholders like long-term partners, not gamblers. Dividends and buybacks are signs of maturity, not weakness. Stock 10, companies I'm willing to hold through storms. The final stock isn't about numbers. It's about temperament. If a company drops 30% and nothing fundamental has changed, I don't panic. I smile, because patience is not passive. It's a competitive advantage. Most people believe wealth is a matter of intelligence, opportunity, or luck. They look at financial success and assume it comes from knowing the right people, having perfect timing, or discovering a secret formula others missed. But over time, a quieter truth reveals itself. Wealth is not built first in the market. It is built in the person. Long-term financial success reflects how someone thinks, how they behave under pressure, and how they treat time, risk, and temptation. In other words, wealth is a mirror. It reflects character. Character shows up when no one is watching. It appears in small decisions, whether to save or spend, whether to learn or ignore, whether to act patiently or react emotionally. These moments don't feel important at the time, but compounded over years, they determine financial destiny. Markets reward discipline, not brilliance. There are brilliant people who struggle financially because they cannot control emotion. They chase excitement, fear missing out, and panic when prices fall. Intelligence without emotional control is like a powerful engine without brakes. It moves fast, but it eventually crashes. Character provides those brakes. Patience, humility, and self-control are not glamorous traits, but they are essential. The ability to wait, to do nothing while others rush, is one of the rarest advantages in investing and in life. Waiting requires confidence, and confidence is built on understanding, not hope. Another mark of character is honesty, especially self-honesty. Successful investors are brutally honest with themselves about what they know and what they don't. They resist the urge to pretend expertise. They avoid businesses they don't understand, not because they lack intelligence, but because they respect reality. This humility protects them from unnecessary risk and costly mistakes. Character also determines how one handles success. Quick money often disappears because it arrives before discipline is developed. Without strong character, wealth becomes a burden rather than a blessing. It encourages excess, entitlement, and recklessness. Money gained without patience rarely stays long enough to compound. True wealth grows alongside restraint. Those who build lasting fortunes often live below their means long after they could afford not to. This is not sacrifice, it is clarity. They understand the difference between what is needed and what is simply desired. They don't confuse consumption with fulfillment. Character is revealed most clearly during downturns. When markets fall and headlines scream panic, the difference between speculation and ownership becomes obvious. Some people flee, locking in losses driven by fear. Others remain calm, grounded in understanding. They see volatility not as danger, but as the price paid for long-term returns. This calmness is not natural. It is cultivated. It comes from preparation, from studying businesses, and from accepting that temporary loss is part of the journey. Emotional resilience is not learned during crises. It is developed long before them. Character also influences time horizon. Those focused on quick gains think in weeks and months. Those with strong character think in decades. They understand that meaningful wealth takes time, just like relationships with dom and mastery. They don't demand immediate results from systems designed to reward endurance. Compounding favors those who stay the course. Integrity is another invisible pillar of wealth. Strong character means aligning actions with values. It means refusing shortcuts that compromise long-term trust for short-term gain. In business and investing, reputation compounds just as powerfully as capital. Trust attracts opportunity. Consistency attracts partners. Reliability attracts returns. When people trust you, doors open quietly and steadily. Finally, wealth reflects character through purpose. Money alone does not create fulfillment. Those who view wealth as a tool rather than a trophy tend to use it wisely. They invest not just for accumulation, but for freedom. Freedom of time, freedom of choice, and the ability to contribute meaningfully. When wealth is guided by character, it creates stability rather than anxiety. In the end, markets don't reward who you say you are. They reward how you behave, repeatedly, over long periods of time. Character shapes habits. Habits shape decisions. Decisions shape outcomes. And over enough time, those outcomes look like wealth. Not flashy, not accidental, but earned. Because true wealth is not just a number on a screen. It is the result of patience, discipline, humility, and integrity, quietly compounding inside the person long before it ever appears in the account. Many people approach wealth as if it were a race against the clock. They obsess over perfect entry points, ideal moments, and precise predictions. They wait for the market to dip, for the right signal, for certainty. In doing so, they often miss the most powerful force available to them. Time. Timing feels intelligent, it promises control, it gives the illusion of mastery over uncertainty. But markets are complex systems influenced by human emotion, global events, and unpredictable change. No one consistently times them well, not because people lack intelligence, but because the future refuses to be scheduled. Time, on the other hand, does not need prediction. It only needs participation. Wealth grows not from knowing when to act once, but from staying invested long enough for progress to unfold. The market rewards endurance far more reliably than precision. Compounding does not announce itself. It works quietly, often invisibly, in the background. In the early years, it feels slow and unrewarding. Results appear modest, almost disappointing. This is where most people give up, not because the strategy is wrong, but because the patience required feels uncomfortable. Time tests conviction. In the beginning, progress is linear. Then, almost unexpectedly, it becomes exponential. What once felt stagnant begins to accelerate. Years of small, consistent decisions suddenly create momentum. This is not luck. This is mathematics combined with discipline. Those who chase timing often trade in and out, attempting to avoid losses and capture gains. Each move feels logical in isolation, but collectively this behavior interrupts compounding. Money that is constantly moved cannot settle long enough to grow roots. Every time an investor exits the market out of fear or hesitation, time is reset. Time in the market matters more than moments in the market. This truth becomes clear when looking at long-term outcomes. Missing just a few of the market's best days, often clustered around periods of fear, can dramatically reduce returns. Ironically, those days are hardest to stay invested in because uncertainty feels highest when opportunity is greatest. Time rewards those who remain present during discomfort. Patience is not passive. It is an active choice to endure uncertainty without reacting emotionally. It requires trusting the process even when immediate feedback is absent. In a world conditioned for instant results, patience becomes a rare competitive advantage. Timing appeals to ego. Time appeals to wisdom. Those who respect time understand that wealth is not built by speed, but by consistency, regular contributions, steady ownership, and long-term thinking outperforms sporadic brilliance. A simple, repeatable approach executed over decades beats complex strategies abandoned after months. Time also smooths mistakes. No investor makes perfect decisions. Errors are inevitable, but time allows good decisions to outweigh bad ones. It provides space for learning, adaptation, and recovery. Timing by company Contrast magnifies mistakes because it relies on being right repeatedly. The longer the horizon, the less individual errors matter. Time also transforms volatility from threat to ally. Short-term fluctuations feel dangerous when viewed up close. Zoom out, and they become background noise. Over long periods, markets reflect progress, productivity, and human innovation. Temporary declines fade into the larger trend. Time turns chaos into clarity. Another overlooked truth is that starting early matters more than starting perfectly. Small amounts invested consistently over long periods often outperform larger sums invested later with greater precision. This is not intuitive, but it is powerful. The willingness to begin, imperfectly, uncertainly, is a form of courage. Those who wait for ideal conditions rarely start. Those who start build momentum. Time amplifies momentum. Time also teaches emotional resilience. Staying invested through cycles builds confidence rooted in experience, not theory. Each downturn survived reinforces belief in long-term ownership. Fear gradually loses its grip. Decisions become calmer, more deliberate. Over time, discipline becomes identity. Ultimately, wealth is not the reward for perfect timing. It is the reward for showing up consistently over long periods. Time does not care about predictions. It responds to commitment. Those who respect time align themselves with its power. They stop trying to outsmart the market and start allowing it to work on their behalf. They understand that the market is not a slot machine, but a machine of compounding. Slow at first, unstoppable eventually. In the end, time does not make people rich overnight. It makes them rich inevitably, if they are patient enough to let it. Because when time is allowed to work, timing becomes irrelevant. Fear is one of the most powerful forces in financial markets. It moves faster than logic, spreads quicker than facts, and influences decisions before reason has time to respond. When fear enters the market, prices fall not because businesses have suddenly lost value, but because people have lost confidence. And within that fear lies opportunity. Most investors believe opportunity appears during excitement. When markets are rising, headlines are optimistic, and everyone feels confident. But by the time optimism is widespread, value is often already gone. Prices reflect hope, not reality. True opportunity arrives quietly, disguised as discomfort. Fear causes people to act defensively. They sell not because the business has failed, but because uncertainty feels unbearable. Losses feel more painful than gains feel rewarding. This emotional imbalance pushes people to abandon sound decisions at the worst possible moments. Markets do not punish fear, they transfer wealth because of it. Those who understand this do not celebrate fear, they respect it. Fear is a signal. It indicates that emotion has overtaken analysis. When prices fall rapidly and sentiment turns negative, it often means expectations have collapsed faster than fundamentals. Fear creates mispricing. Great businesses do not lose their long-term value simply because of economic cycles, political uncertainty, or temporary setbacks. They continue to produce, serve, adapt, and earn. But during fearful moments, they are priced as if the future has been permanently damaged. This gap between price and value is where opportunity lives. The challenge is that fear feels convincing. It always comes with stories, narratives that justify panic. Headlines amplify risk. Commentators predict worst-case scenarios. Every reason to sell sounds rational in isolation. Opportunity rarely feels obvious. It feels lonely. Acting during fear requires emotional discipline. It requires separating temporary uncertainty from permanent damage. Most people struggle with this distinction. They assume falling prices mean falling value, even when nothing fundamental has changed. The disciplined investor asks a different question. Has the business itself been permanently impaired, or is this simply a storm? If the answer is a storm, fear becomes a gift. Fear also compresses time. People focus on days and weeks instead of years. Short-term volatility overwhelms long-term perspective. This shortens attention spans and increases urgency to act, often in the wrong direction. Those who maintain a long view gain clarity while others lose it. Opportunity does not require bravery in the traditional sense. It requires preparation. Confidence during fearful times comes from understanding what is owned. Those who study businesses deeply are less swayed by market noise. Knowledge acts as an anchor when emotions rise. Without understanding, fear controls behavior. With understanding, fear creates possibility. Another reason fear creates opportunity is that it removes competition. When everyone is optimistic, prices are bid up by crowds. When fear dominates, those crowds disappear. Fewer buyers remain, and value becomes available without resistance. Opportunity thrives in emptiness. This is why the best decisions often feel uncomfortable in the moment and obvious in hindsight. Fear makes good prices possible, but only for those willing to endure emotional unease. It is important to distinguish fear from recklessness. Opportunity does not mean buying blindly or ignoring risk. It means recognizing when risk is already reflected in price. When expectations are low, even modest outcomes can produce strong returns. Fear lowers the bar. Over time, repeated exposure to fear builds resilience. Those who survive downturns learn that panic is temporary. Markets recover not because fear disappears, but because progress continues despite it. Each cycle reinforces the lesson that fear is not a forecast, it is a reaction. The most successful investors do not eliminate fear. They learn to coexist with it. They accept discomfort as part of the process. Why understand that if an investment feels completely safe, it is probably overpriced. Risk and reward are inseparable, but fear often exaggerates risk while hiding reward. Fear distorts perception. The final truth is that fear is universal. Everyone experiences it. The difference lies in response. Some flee, others freeze. A few step forward thoughtfully. Those who step forward do not do so because they feel fearless, but because they have trained themselves to act rationally when fear is loud. In the end, markets do not reward the absence of fear, they reward the mastery of it. Fear creates opportunity because it forces prices below value, shortens perspectives, and clouds judgment. Those willing to remain calm, patient, and grounded during such times are offered what optimism never provides, true value, and when fear fades, opportunity often disappears with it. There are two very different ways people participate in the market. One is quiet and patient. The other is loud and restless. One builds wealth steadily over time. The other chases it anxiously from moment to moment. The difference is not strategy. It is mindset. Ownership is about commitment. Speculation is about prediction. When someone owns a business, they think like a partner. They care about how the company earns money, how it treats customers, how it allocates capital, and how it plans for the future. Time becomes an ally. Volatility becomes background noise. Speculation, on the other hand, is focus, set on price. It asks only one question: what will someone else pay for this tomorrow? It thrives on excitement, rumors, and momentum. It requires constant attention and constant accuracy. Two things no one can maintain for long: ownership builds, speculation reacts. True ownership begins with understanding. It requires knowing what the business does, how it creates value, and why it will remain relevant years from now. This understanding creates conviction, the kind that holds steady when prices fluctuate. Speculation does not require understanding. It relies on belief that price will move, not that value will grow. This disconnect makes speculation fragile. When sentiment shifts, confidence collapses. Ownership provides stability because it is rooted in reality. When markets decline, owners ask whether the business has changed. Speculators ask how much further the price might fall. One responds with analysis, the other with emotion. Speculation often feels exciting because it promises speed. Ownership feels slow because it respects time. But speed amplifies mistakes, while time smooths them. Most wealth is not made in days or months. It is made by allowing good businesses to compound quietly. Ownership aligns with compounding. Speculation interrupts it. Speculators frequently trade in and out, resetting the compounding process each time. Taxes, fees, and poor timing erode returns. Ownership avoids these frictions by remaining invested, letting gains build upon gains. Another difference lies in stress. Speculation demands attention. Prices must be watched, news followed, and emotions managed constantly. This creates anxiety. Ownership requires patience, not vigilance. The owner does not need to check prices daily because the focus is on progress, not fluctuations. Peace is a dividend of ownership. Speculation often disguises itself as intelligence. Charts, indicators, and predictions give the illusion of control. Ownership is humbler. It accepts uncertainty and focuses on fundamentals that can be reasonably understood. Those who speculate often confuse activity with productivity. They feel productive because they are constantly acting. Owners understand that doing nothing is sometimes the most productive choice. Ownership also encourages responsibility. When someone views themselves as an owner, decisions are filtered through long-term consequences. Short-term temptations lose their appeal. Growth is prioritized over excitement, sustainability over speed. Speculation rewards impatience only when luck intervenes. Ownership rewards patience consistently. Another overlooked truth is that speculation depends on someone else's behavior. It requires another buyer willing to pay more. Ownership depends on the business itself, on earnings, cash flow, and value creation. One relies on psychology, the other relies on productivity. Psychology changes quickly, productivity compounds over long periods. Businesses that serve real needs, operate efficiently, and adapt responsibly tend to grow in value. Owners benefit from this growth regardless of short-term market opinion. Speculators must constantly guess how opinions will change. Ownership turns investing into a partnership with progress. There is also a moral dimension to ownership. When you own a business, you share in its successes and failures. You benefit when it creates value for customers and society. Speculation is indifferent to outcome. It profits from movement, not meaning. Ownership aligns incentives. Speculation extracts from volatility. Over time, ownership builds confidence rooted in experience. Each cycle survived reinforces trust in the process. Speculation builds dependence on constant stimulation, making stillness feel uncomfortable. The most powerful advantage of ownership is that it frees the mind. It removes the need to be right today. It allows mistakes to be corrected by time. It transforms investing from a contest into a journey. In the end, markets do not reward excitement. They reward endurance. Ownership beats speculation because it aligns with how wealth is actually created, through patience, productivity, and long-term thinking. Speculation may offer stories, adrenaline, and occasional wins. ownership offers something rarer, lasting wealth. Final reflection. Getting rich without getting lucky requires one thing most people avoid: waiting, letting compounding do the heavy lifting, letting fear work in your favor, R. Letting time reward discipline. The stock market transfers money from the impatient to the patient, quietly, relentlessly, and fairly. Buy wonderful businesses, pay reasonable prices, hold them with conviction, and in 2026 and far beyond, wealth will follow, not because of luck, but because of wisdom.